Check. Good afternoon, everyone. Welcome to the Simple Plan Online. Today's show, we're going to look at what it takes to retire. For those of you who've been watching last episode, we took a look at the facts of financial planning. That is the 4 stages that we go through: foundation, accumulation, conversion, and transition. And prior to that, we did take a look at a calculator that helped answer part of the equation about retirement. But today I want to show you a calculator that's going to help you figure out not only how much money you're going to need to accumulate, what we call your nest egg, but also how much money you need to be saving today in order to reach that target. And you're going to have access to a calculator to check that out for yourself. So thanks very much for joining us today. I'm Brad Macbeth. Really glad you're here with us. And you can always follow us on Facebook. It's Macbeth Group. You can also find us on Instagram and Twitter, Cash Coach Canada on Twitter, and Macbeth Group on Instagram. Want to thank our sponsors today. That's the Simple Plan Life Insurance. You can get your own life insurance quotes from all major Canadian insurers at getthesimpleplan.com/quotes. You can also calculate how much life insurance coverage you need at getthesimpleplan.com/how-much. And, this is a great time to do that because life insurance rates not only have never been lower, they're probably never going to be this low again. We did a whole episode on that, but they've been coming down over time primarily due to competition and both medical and longevity advances. But insurance rates are tied very much to interest rates, and when interest rates are super low like they are now and have been and will be for quite a while probably, that's very hard on the insurers. So they are going to have to start raising their prices, I'm guessing probably in a few months. Also, the only good news that we've had, or a little bit of it out of the pandemic, is that right now you can qualify for up to $2 million of life insurance without having to go through the usual annoying poking and prodding and needles and samples and that kind of stuff, just by answering questions. So you might want to check that out. Now, we always have a helpful article, and today's helpful article is actually our tool. It's the Simple Plan Retirement Calculator. You can find that at bit.ly/SPRetireCalc. That's bit.ly/SPRetireCalc, C-A-L-C. So once you've had a look at what this is all about, head over there and check out what that's going to look like for you. So we're going to get down to it and have a look at this calculator, which you'll find if you go to that website that we just talked about. So here's the calculator. It's not super fancy, but it's going to give you some pretty comprehensive information that's really going to help you out. So it asks you some basic questions, such as, what's your age? So we're just going to make someone up here. So let's take someone who's 35 years old. So you can enter your information in yellow cells, just like it says there. Click Next. And so in today's dollars, how much money will you want monthly to live on? So that's a retirement budgeting question. You need to have an idea of how much money you're going to need to live on when you retire. And we're expressing everything in today's dollars because the calculator itself will actually adjust for inflation. So let's say that we want, I'm going to say $6,000 per month to live on. And we're going to give you some tools in the not too distant future to help you put that retirement budget together. But we've done programs on budgets before. Just make yourself a budget for how you think you're going to need to live in retirement. Hopefully you should have no debt. You should perhaps have a house that's paid off and some assets that you've accumulated. All right, so other than your savings, what are you going to have as sources of income? So many people are entitled to some amount of Canada Pension Plan, and most people, not everyone, but almost everybody is entitled to OAS or Old Age Security, and other people have other pensions. So let's put the numbers in there. Now, if you don't know what your CPP entitlement's going to be, you probably need to check that out. The maximum, most people don't qualify for the maximum amount of Canada Pension Plan. We talked about that in another show. I think I might even have it. I do have it right here. So maximum Canada Pension Plan currently, Old Age Security is $614 if you get the max. And a lot of people get the max. That's really just about whether you're a citizen and through your working ages, your career ages, you were Canadian. So the maximum CPP, look at that, doesn't even tell us that on this sheet. Maximum CPP is running around $1,200 a month. Most people, almost nobody qualifies for that. Some do, but many don't. So we'll put $1,000 a month in for this person. That would be pretty good. And then we're going to assume they have no other pension. Now, obviously, if you had a pension, a couple things. First off, you're going to put that amount of money in there. And if it's a defined benefit pension, or actually many defined contribution pensions, that's going to have lowered the amount of CPP you're eligible for as well. Anyway, you can get that CPP information from Canada Revenue Agency or Service Canada. If you go to the Service Canada website, you can get all logged in there and actually check out your current trajectory for CPP. So then we want to ask the question, what age will you retire? We'll say 65. A lot of people still say 65. Personally, I'm an advocate of if you're able, by all means, work longer than that because people are living longer. You know, here's some math for you just to think about this. If you start work when you're 18 and you're going to live till you're 95, well, actually, you know what? Let's say you start work when you're 22 because you come out of college and you're going to live to you're 95. That's 73 years. Now, if you retire at 65, that's going to give you 43 years of work, and you're going to have to fund 30 years of retirement. That's a lot. Think about that. I've got 43 years to set aside 30 years worth of living money. That's a big task. So that's how those numbers kind of go. So that's why we're a bit of an advocate of working longer if you're up for it. Also, people tend to do better as they continue being occupied. Maybe you'll switch careers at 65. Maybe you stop doing what you normally do and you decide to go do something else, and it's not making you as much money, but it's enough to get by on, and it's purposeful, meaningful stuff for work that matters to you. Anyway, lots to think about there. We're going to do a whole show on retirement and what that means. So here's the income that you're going to need monthly based on 3% inflation. Because what did we say? Let's just go back. I think we said 60. Yeah, we said 6,000. So in today's dollars, remember this person's 35. So in today's dollars, in today's 6,000, 30 years from now, because that's when the 35-year-old is going to be 65, you're going to need $10,646 a month to have the equivalent of $6,000 in monthly income. That's based on 3% inflation. Now, that's what's built into the calculator here. You're going to see you get a chance to actually adjust that. All right. So if I want to live, so here's the next question. Fine, I need to accumulate. I'm going to live on this much. How much of a nest egg am I going to need in order to be able to live off it based on, in this case, we've set an annual rate of return at 8%. Well, you can see you're going to need almost $2 million. So just to review, if you're age 65, retiring, and you want to live on $6,000 a month in today's equivalent, and that starts 30 years from now, you're going to need nearly $2 million based on 3% inflation and 8% investment rates of return. All right, well, that's a tall order. So what do we need to do to get there? How do we get to our $1.963 million? Okay, well, how much is our 35-year-old already saved? Well, let's say that they've already saved $37,000. Oop, nothing's typing. There we go. So we've already saved $37,000. All right, so here's how much we're going to need to save every month in order to hit our target by age 65 at 8% rate of return, having gotten to that $2 million, and that's with 3% inflation happening. The 3% inflation isn't a part of that calculation, but at 8% rate of return, we need to save $1,046 a month to hit our goal of nearly $2 million by the time we're 65. Okay, that might sound like a big number. Depends what the person's earning, but let's say that maybe right now they're only earning $5,500, or maybe they're earning $6,000 a month right now. So that means they're going to need to save 1/6 of their income. 1/6, that's about 16%. So that's not, that's slightly higher, but normally we say, you should be saving 15%, but that's right in that ballpark. All right, so here's where we get to our final display and calculation of all the numbers. So we're 35 years old today. Our monthly income target in today's dollars is $6,000. We're going to retire at age 65, which means that's $6,000. To have a $6,000 2020 lifestyle in the year 2050, that's 30 years from now, you're going to need $10,646 based on 3% inflation. You're going to need to accumulate a total of $2 million to have that $10,000 a month income for the 30 years from the time you turn 65. And if you've only got $37,000 currently saved, you're going to need to save another $1,046 monthly. Now, you could adjust some things. You probably don't need to adjust. These are just where you're at. If you're a real person, not a fictional person like we've made up here. But here's something we can look at is what are the effects of better or lesser rates of return and inflation rates? So 3% as an inflation rate is actually pretty high for what we've been experiencing for the last 20 years. It's actually lower than the long-term rate of inflation, which is a little over 3. But we've been at 2, and we're definitely lower than 2 now. We're probably more in the 1% range or a little over that. So let's set it to 2 and see what happens. I enter 2 and I just hit the tab key, and okay, so that's made some adjustments. You can see now I only need to save $1.3 million because at 2% inflation, I'm going to need a little less than $8,000 a month. So my monthly future need is $2,000 less than what I'm getting now, or what I was going to get at 3% rate of inflation. Now, some people might say, gosh, 8%, that seems too high. Let's go for 6. Well, you can imagine the effect that's going to have. That puts us up again, means we now need 1.65 million. Of course, it doesn't change the amount that we're going to be living on because that's calculated that's an inflation calculation based on the 2%. We're pretty strong advocates that you can get 8.5%. maybe 9 over long periods of time if you're in aggressive equity portfolios. But that's over long periods of time. You need a lot of time to make that happen, because less time, there's just much more volatility and much more risk. So if we're at 8.5% and 2%, well, now we only need to save $470 a month. So let's think about this a bit. Now you can see that your assumptions are very important here, and you need to be very comfortable with them, because once it all plays out, when you get to age 65 and you're wanting to retire, if you've assumed that inflation was low and investment rates were high, and it didn't turn out that way, you don't have time to adjust now. The only thing you're going to be able to adjust is to downgrade your lifestyle. And we want to avoid doing that. So you want to be making assumptions based on things that you're very confident about and comfortable with. The other thing you want to do is review regularly. And that's where probably the biggest downfall is. Well, the two downfalls are, first off, the vast majority of people do not have a financial plan. They have no financial plan whatsoever. Well, why is that? Well, it's because they don't work with someone who puts together a financial plan with them and for them. The vast majority of people get their investments over the counter at a bank, and the bank will ask you some questions, as many advisors will, that are really just a variety of cover their butt questions. They're usually called risk tolerance questionnaires or something like that. And rather than actually looking at where you need to get to and showing you what the results are going to be of your assumptions, instead they just simply say, well, based on your risk tolerance, you should be in a balanced fund. I used to work in larger organizations where we did that kind of stuff. And I found that when I wanted to do my own investing and where I was prepared to take more risk, I had to really game the questionnaire to even get to a point where I could actually have it say, oh, well, you're ready for higher risk investing. You really, really have to answer it in a certain way to get that response. Almost always, the answer is going to come out low risk or medium risk. Well, why is that? Well, here's the reason. Because everything is complaint driven. The regulatory system is not well structured it's to protect investors from things going badly. And that's a good thing. It absolutely should be very strong to protect them from lies and frauds and that kind of thing. But because of this, people complain when they invest and don't get the result they were expecting. So if instead of investing and expecting an 8% rate of return, they're now told that they should expect a 4% rate of return, then they're not going to have anything to complain about. We told you were going to get 4. You signed on the dotted line you were going to get 4, and you got 4. It's like, well, that's great, except the problem is I didn't even get halfway to where I needed to live reasonably well in retirement. And that's kind of how the system is set up, because the lower risks that the banks and the other investment firms have people take, the more comfort there is for them that the client is not going to complain about the investment rate of return they received. And so that's basically how that all pans out. And it's unfortunate. It's a byproduct of an imperfect system, but it's in the bank's interest to have you at a balanced fund, so 50% bonds, 50% equities, or even more on the bond side than it is, or fixed income side, than it is for them to have you taking more risk. And so that's kind of how things have played out. Now, I'm not making this a whole long episode on risk and return. That's a very interesting subject on a whole bunch of fronts, but just saying that's how these things play out. So let's look at what you would, with a typical kind of bank scenario. Here's what you would expect. So if you're going in a Canadian balanced fund, you might expect 4.5, maybe 5%. I'm going to go on the low side here, and we're going to say, and we'll put inflation at 2.5. So now how much do you need to save monthly to hit that target? It's triple what we were looking at. The rate of return is so important, and you can't control it other than to invest reasonably over a long period of time, because that's where you can get more certainty about the types of results you're going to get. You can never get pure total certainty. You're always taking risk. But here's the downside of not taking risk. Let's say that you go with something that's even more conservative. It's 70% fixed income and 30% equity, so maybe you're going to expect 3% rate of return. And we'll even go a little lighter. We'll call the inflation 2%. Well, now you need to be saving $4,000 a month. So here's the problem. There's a lot of Canadians that have invested their money. They're thinking, oh, I got money in my RRSP, and it's churning away. It's getting nothing because they don't have a plan. Number one, they don't have a plan. Number two, they never go back and review their plan. And that's the other critical part, is you've got to review the plan. So part of what you're reviewing when you review the plan is, how are my assumptions playing out? Are the returns, are the results we're getting within what you would anticipate based on our bigger projections? So maybe you can think about all this stuff yourself and figure it all out, and that's great. I'm a big advocate of people doing it for themselves if they're capable of it. But this is a good reason to work with a capable advisor, not just a salesperson over the counter at a bank or something like that. And you'll have to look hard to find someone, believe me, because most advisors are trapped inside some kind of a system that's similar to a bank. Doesn't matter if you're at the bank or some of the other bigger investment firms, the brand names that you know, they're all kind of playing the same approach to things. And I'm not condemning anybody. And I can tell you the banks have a fantastic business model. I tell people all the time, the best thing you can do with a bank to take the greatest advantage of it is buy bank stock, because they perform very well. But don't place your financial future without an awful lot of understanding and consideration in the hands of people who are working inside that kind of a big machine, because they're just going to churn out this type of a result. And so you should have a plan. We're going to look in a couple of upcoming episodes what an actual plan looks like, what it calculates, and where your assumptions are, so that you can understand even more. We're kind of drilling down into the deeper levels of understanding of what these things are about, so that you can know whether you've got a plan or not. Because I can tell you that in 18 years in this business, almost every family I've worked with, when I ask them, do you have a financial plan? They'll kind of mumble sheepishly and they'll go, well, yeah. And I'll say, okay, fantastic. Can you give it to me? Can you show it to me? And they don't, it's not written down anywhere. It was in discussions or what have you. Or they pull out one of two things. They pull out a statement from an investment fund, like an RRSP, tax-free savings account, or quite commonly from their workplace, either pension plan, which those people are much better off, believe me, or from the defined contribution pension plan or their DPSP in the workplace or something like that. But it's just a statement. There's no plan. A plan assesses where you're at, where you're going, and how you're going to get there. These are just statements. All they are is, here's where you're at. Doesn't tell you anything about where you're going and how you're going to get there. And so that's one thing. The other thing they'll pull out is these actual risk tolerance questionnaires, which are ridiculous. They really should be banned or completely redone. They're worse than useless. They're very damaging. But the system is trapped in them because regulators say, oh, you got to use them, and or you have to have something. And so that's what they use, because it seems like it gets at the issue, but it doesn't get at it whatsoever. So they'll pull out a risk tolerance questionnaire, which says, oh, you should be in the balanced fund. There's a reason that the Royal Bank Balanced Mutual Fund is the largest mutual fund in the country, or one of them. It's because the biggest bank in the country is the Royal Bank, and what everybody gets steered into is the local flavor balanced fund. It's not because it's spectacularly performing or the fees are really low or anything else. And again, I'm not slagging the Royal Bank Balanced Fund. I'm just saying that's how the system works. So the problem is you have to get in and have a plan. You have to look at these kinds of calculations, because if you're making $6,000 a month, the idea that you're going to save $4,000 a month doesn't seem very likely. So this is why it's very important to have a plan and to be checking the plan regularly. Anyway, that's a long rant. I just wanted to share with you how this works. When you come to this, if you've already got some information in there and you want to start over again, you just click cancel. It'll clear all the data and take you right back to the beginning again. So that's how you can calculate how much money you are going to want to live on in the future, how much you're going to need, how much that's going to total when you get there, and how much you need to be saving today to get there based on your assumptions. So I hope you found that helpful. It's a very powerful tool. Once again, you can find us on Facebook at Macbeth Group. You can find us on Twitter at Cash Coach Canada and on Instagram at Macbeth Group. Be sure to check out our sponsor, the Simple Plan Life Insurance. Get your free quotes from all major Canadian insurers at getthesimpleplan.com/quotes. And you can check out how much life insurance you probably should have at getthesimpleplan.com/how-much. Lastly, be sure to go and check out the calculator we just looked at. You can just head right over there and use it and play around with it and see where you should be at. If you want to get in touch with us, you can get in touch with us through our website. That's where you'll find that calculator. You can get there at bit.ly/SP-Retire-Calc. That's bit.ly/SP-Retire-Calc, all one word. Thanks very much. I hope this has been helpful to you. And if you have any questions, send them our way. We are happy to answer anytime you have any questions. And that's also where we get our ideas for our shows, from the questions that we receive. Thanks very much for tuning in today, and we'll see you again in a few days.